January 2026, the US dollar is falling for a second straight day, and the markets are trying to decide, is this just another geopolitical chess move or the start of something much deeper? The dollar index dropped another 0.3%, breaking below 98.84, its lowest level since the 12th of January. And the trigger, not inflation, not jobs, not interest rates, but Greenland. Yes, Greenland. The White House has once again raised national security concerns, this time pressuring the EU over future control of the island. The result, the return of the Sell America playbook. It's almost identical to the pattern we saw last April when tariff threats set off a chain reaction, dumping us stocks, bonds, and the dollar all at once. Now, it's happening again, not because investors are abandoning the dollar long term, but because they no longer trust the stability of US leadership in the short term. As one analyst in Sydney put it, this isn't just fear over trade policy, it's fear over alliances, retaliation, and the acceleration of de-dollarization. It's not a crisis, but it is a signal, and the markets don't wait for certainty. They react to expectations. And when capital starts shifting based on what if, it can snowball fast. The euro rose to $1.1663. The pound to $1.3435. Normally, you'd expect euro and sterling to weaken on tariff fears. But this time, the flows are being driven by anti-dollar sentiment. It reminds me of 2022, when trades weren't about which economy was strongest, but which one looked the least unstable. The yen slipped 0.2%, which is unusual during global uncertainty. But in this case, Japan's internal politics are the reason. Prime Minister Takaichi has called snap elections for the 8th of February, and her plans to suspend food taxes have spooked the bond market. Investors didn't rotate into the yen. They're watching from the sidelines. A weak 20-year bond auction only confirmed that hesitation. The offshore yuan held steady at 6.95, but it's still sitting at its weakest point since May 2023. China, as always, is playing the long game, no rate changes, no surprises. That's not a weekly strategy, that's a year-long stance. Meanwhile, Indonesia's rupiah just hit a record low of 16,985 to the dollar. Why? Political interference. President Prabowo's move to appoint his nephew to the central bank board raised alarms. Investors don't like it when monetary policy becomes a family business. That principle holds true anywhere in the world. Australia and New Zealand went the opposite direction. Both currencies rallied. The Aussie rose to $0.6741. The Kiwi hit $0.5835. In times of global uncertainty, secondary currencies sometimes become safe havens, especially when larger markets are wobbling. And now, the part that hurts. Crypto. Bitcoin dropped 2.2%. Ethereum fell 2.9%. Not a collapse, but a clear signal. Traders aren't rushing into crypto as the dollar weakens. Instead, they're rotating out of risk entirely. This marks a tone shift from risk on to risk off. So what we have here is a market under pressure, not from data, but from dynamics. The dollar is slipping. US leadership is being questioned. Allies are cautious, and traders are adjusting. Anyone who's traded long enough knows this feeling. The numbers still look okay, but the money is moving differently. Not loud, not fast, but with purpose. The 23rd of January, Spain's IBEX 35 heads toward a mildly negative weekly close. But what matters is not just where it ends, but how it gets there, after a few days of tension driven by us. Political statements around Greenland and tariffs. The market has cooled, but not because conditions are stable, more because investors are simply getting used to chaos. And that comfort zone can be dangerous. The IBEX dropped 0.47% today, closing around 17,580 on the surface. It looks like nothing major happened. But if you look underneath, you'll see weakness in key sectors like IAG and steel makers. These are industries deeply tied to global trade and geopolitical stability. So when they underperform while indices hold steady, that's a market waving a subtle red flag. Last session's rally had less to do with strong fundamentals and more to do with temporary relief. a partial rollback of U.S. tariffs on European goods tied to a preliminary deal with Greenland. But when a market bounces on words rather than actions, the support is thin and it doesn't last long. Meanwhile, US data has added complexity. Final GDP numbers for Q3 came in at 4.4% above expectations. PCE inflation, the Fed's preferred metric, ticked up to 2.8%. That alone shifts the tone heading into the next Fed meeting. The rate cut narrative just got a little murkier. Markets don't like mixed signals, especially when priced for clarity. And that tension showed up clearly in Intel stock. Despite beating earnings estimates, Intel gave a weaker forward outlook and dropped over 13%. That's not a reaction to data. That's a reaction to doubt. Markets right now are more interested in the forecast than the report card. That's a classic signal that we're moving from optimism to realism. Looking over to Japan, the Bank of Japan kept rates steady at 0.75%. No surprises there, but they revised their economic outlook upward. Inflation is still hovering above 2%, but moderating. Interestingly, one board member proposed raising rates to 1%, citing growing inflation risk. It was rejected, but just the suggestion is a sign of internal pressure. And when even Japan starts talking about hiking, the global tone is shifting. Japan's PMI numbers for January showed strength, manufacturing up to 51.5, services at 53.4. This comes as China remains soft. A possible rotation in capital flows across Asia could be brewing. And here is the big one, gold. It's now flirting with the $5,000 mark, historical highs driven not by fear, but by demand for safety. Silver is up over 2.5%. Meanwhile, the U-VERP 10-year yield remains steady at 4.23%. That tells us money isn't panicking, but it is quietly rebalancing. Crypto holding Bitcoin trades at $89,051. Ethereum just under $2,940. That's what I call line holding. The market's not buying aggressively, but it's not selling off either. From experience, these phases often precede explosive moves, not because of headlines, but because of what happens when the noise fades. Accumulation, hesitation, then snap. So what are we really seeing here? A blend of technical stability, underlying anxiety, and political fog. And when you line that up, it doesn't create a stable market. It creates balance before break, like a mountain that looks calm right before the first rock slides. So what we have here is a market under pressure, not from data, but from dynamics. The dollar is slipping. US leadership is being questioned. Allies are cautious. And traders are adjusting. Anyone who's traded long enough knows this feeling. The numbers still look okay, but the money is moving differently. Not loud, not fast, but with purpose. And when capital starts choosing between politics and protection, the next move matters more than the last.